going to go back over the last quarter, and then we're going to take a longer look back over 2 years so that we can give you some perspective of what's really gone on in the markets and looking at a broad-based rally in all equities and in fixed income in the final quarter of 2023. Hey everybody, I'm Dean Barber along with Bud Kasper. This is the quarterly update from Modern Wealth Management, and we're sitting here on the 10th of January, 2024. Bud Kasper's in Lee's Summit, Missouri. I am in Treasure Island, Florida, so coming to you virtually. Bud, welcome.
Thank you.
So 2023 proved to be a year for, I think, the record books when it comes to what we saw happen with interest rates and even that in fixed income and bonds. It looked like we were going to have a third consecutive year of negative returns in bonds, but that did not transpire. So, Bud, you've got some data on the 10-year Treasury and where it wound up at the end of 2023 and where it started 2023. So let's talk a little bit about that to begin.
Oh, thank you, Dean. Yeah, I think it's important for people to take a longer-term understanding of what's been going on and looking at the catalysts that are causing the markets to react the way they are. So if we go back, at 2023, we knew the Federal Reserve was well in the midst of raising rates. And of course, that was putting a damper on the markets at that particular time. And that followed through all of 2023 until we finally got to October. And then at that time, we started to get better numbers that were coming out. The Federal Reserve was obviously making a huge impact as to how inflation was reacting at that particular time. And a result of that was an incredible rally in the last quarter of 2023 that was certainly welcomed by all investors at that particular point. So the question that we have right now is, with the 10-year finishing 2023 at 3.9%, that's the U.S. Treasury bond, folks. And as we look at this moving forward, will bonds still be able to gain positive returns and still making up the losses that it had back in 2022? And the answer is yes, it seems to be on course. Quite frankly, the Federal Reserve has done a pretty good game here. And, they're always under continual scrutiny associated as to whether they've overstimulated, understimulated, whatever the case may be. But I think we can all agree that most certainly since October 30th of the last year, we have seen the results of what the Fed action has done, and it's been positive for both bonds and stocks.
No, you're right. I want to share my screen here for just a minute and go through a little bit of some charts on 2023. So this is the final quarter of 2023. And what we're looking at here is SPY, which is the SPDR S&P 500 ETF trust, and then the Invesco S&P 500 equal weights. And then we've got AGG, which is the iShares Core US Aggregate Bond. So if you look at here in the final quarter from 10/1/2023 to 12/31/2023, we had 6.75% on the bond ag, and then we had 11.64 on S&P 500, and the equal weight actually outperformed the S&P 500 at 11.81%. But what's interesting is when we go back and we take a look at a little bit longer time frame, and we go back to January 1st of 2022, and as you all will remember, January 1st of 2022 was the beginning of a substantial downturn in the markets in pretty much across the board. It was the worst year in on the record books for bonds, where we had bonds negative 13%, and that was also followed by a year where we lost money in bonds in the prior year in 2021. So I think what's interesting here is, even though you had an S&P 500 up by 26%, you had an equal weight up by 13%, and you had the bond ag up by 5.65%. That 2-year period, the bond ag is still negative 8. The equal weight is just barely positive, and the S&P 500 only up by 3.26% over that full 24-month period of time. And I want to really quickly here, because I know we don't want to take a lot of time with this, but I want to go to January 1st of 2023 and just look at that year. And what I want to point out here is that the equal weight and the S&P 500 were kind of tracking with each other all the way out here till early in March. And the phenomenon of the artificial intelligence, ChatGPT started to take hold in real fashion. And we saw then what was termed as the Magnificent Seven really take over the markets. And as you can see, the S&P 500, because of the Magnificent Seven, really outperformed everything else.
I think that's the way most investors need to look at the stock market, because the other one, as we just saw, the biggest representation that I've seen in 40 years of doing this, that it's skewed it incredibly in favor of those particular stocks that were in great favor. We know that having the consumer that's vibrant and active is good for economic growth. And if the Federal Reserve has done their job, and let's say that in the first quarter, second quarter, which I don't believe it'll happen, I think in the third quarter, we could see the Federal Reserve start to lower rates. And if they do that, I think that's very stimulative. When we go in and we look at mortgages, as an example, 65% of households in America own a home. Now, Forbes recently reported that 40% of those owners do not have a mortgage, meaning that they've paid it through, which is wonderful. What does that mean? It means that they have discretionary money that they wouldn't have otherwise if they had higher mortgages to be able to put what back into the economy. And so for those that have mortgages, 95% of those are fixed rate, and they're below the current rates. So again, it's not hampering, if you will, spending from that perspective. So if we look at that, and we understand that 70% of U.S. activity is consumption, I'll beg the question that the consumer is not going away. And if the Federal Reserve lowers rates, it's going to put them more in a position to be able to spend. And that'll be good for the American economy.
So, Bud, it sounds to me like you don't think there's a recession on the horizon in 2024 based on that commentary.
Dean, I've been waiting for that recession for the last 15 months. It's never come about. I'll never say never, but I think the favorability in terms of the economic data that matters is positive.
And the reason why I wanted to show that 2-year chart for the S&P 500 and for the equal weight is because I think in a lot of people's psyche, we have what's called recency bias, which is we're looking at what's happened recently. And so I think when the market finished up on such a strong note in 2023, a lot of people are expecting, well, the market's now here at all-time highs. We're going to go back. But look, as I just showed, we're where we were 2 years ago. Mm-hmm. And so the question is, are companies healthier than they were 2 years ago? Are consumers spending more than they were 2 years ago? And when you go through a 2-year period where you have zero return and you have a 60-40 portfolio where you're still in negative territory over that full 24-month period, I think there's still opportunity in front of us. I don't think that we're going to see, the high, the mid-teen type or 20% type returns in 2024. But I would say, Bud, that I think that there is still the possibility of a mild recession taking place in 2024, but I don't see anything that I think would be a deep recession causing major concerns. And there are areas within the market where there is opportunity. And if you think about where bond yields are today relative to historical numbers, let's just go back over the last 15 years, bond yields are actually in a good spot today. So even if we say, hey, the 10-year Treasury is at right about 4% as we talk today, if it finishes the year at 4%, that bond ag and most bonds are going to wind up positive by 4.5 to 5% or whatever the coupon is. And if
history would bear that out. It's not too common for, I'm going to use your phrase, Dean, bonds are supposed to be a stay rich investment, and they most certainly haven't been in the prior 2-year period. However, they will come back. The best thing is to stay calm. It would be remiss on our part, gentlemen, if we didn't talk about the election, because every client that comes in is asking the question, is the outcome of the election going to impact my money? And the answer is, over time, is minimally. So there's going to be a lot more other factors other than who's in the White House, even though most people are very, very concerned, about how our country can move forward in a positive direction with all the chaos that seems to be going on around us, not just here domestically, but around the world.
Yeah, no, I agree with that. I think the elections get a lot of hype and they cause a lot of people to be extremely nervous about things. But really, as you said earlier, Bud, the consumer drives 70% of our gross domestic product. Corporate spending is another 15%, and government spending is another 15%. I don't know about you guys, but I don't see the government slowing their spending. And as we talked about earlier, the consumer is very healthy today. So that just leaves corporate spending. And corporate spending would have to fall pretty precipitously in order for us to go into a negative GDP type of a scenario. So I do think that, we've been critical of the Fed a little bit here over the last couple of years. They waited too long. They went too fast. But as we look at it today, it appears that we need to give the Fed a little bit of credit that they did a nice job. And, I think they have a better probability than not of engineering a soft landing. So as we enter into 2024 here, once again, I'll wish everybody a happy new year. We'll keep our eye on things. And as always, we encourage you to keep the communication open with your advisor here at Modern Wealth. Thanks so much for joining me for the quarterly market and economic update here at Modern Wealth Management. Just a quick reminder before I let you go, this is our new channel for Modern Wealth Management. For our monthly economic updates and our educational series, please make sure that you subscribe to this channel. And as always, we encourage you to share with your friends.